Last class we started our discussion on the normal distribution, and we said this is a nice distribution because it makes investment so much easier. However, in reality, you will see that asset returns are generally not following normal distribution, and there are major two concerns. There are major two deviations from the normal distribution assumption. The first one is asymmetry. The second one is fat tail. So let's first define how to measure the asymmetry of a probability distribution, and then we will define how to measure the fat tail of a probability distribution. So we will use skewness to measure the asymmetry of a distribution. And if you're having a probability distribution, skewness is measured at this. That is the deviation from the mean and with the exponential of 3 and then using expectation divided by the standard deviation. And then if you're having some realized returns, right? That is some actual returns calculated from historical data, then in this case you would just use the average deviation. Again, you have to use the exponential 3 divided by the sample standard deviation, again with exponential 3. So, well, I don't think I will ask you guys to actually calculate these two numbers, but you have to understand what are these numbers for, right? Obviously, these numbers are for measuring the asymmetry of a probability distribution or the asymmetry of realized returns, right? And then if you have a normal distribution, the skewness is 0. This is easy to understand, right? Because skewness measures asymmetry. And we know that normal distribution has a bell-shaped probability density function. So it is a perfectly symmetric distribution, which means its skewness should be 0. And then you could imagine that there are some distributions or the distribution from realized returns would possibly look like this, right? So in this case, we say it is left skewed. And you can see why this is called left skewed. The reason is because this is the skew here, right? The skew is on the left. And if you do the calculation, you will find out if a distribution is left skewed, then its skewness is actually smaller than 0. So we also say it is negatively skewed, right? So basically, if a distribution is left skewed, then its skewness should be negative. So it is negatively skewed. Now, there's the other case, right? So if a probability distribution looks like this, then obviously this is right skewed because again, the slope is on the right. And in this case, if you do the calculation, the skewness is positive. So we also say this distribution now is positively skewed. Now, why does skewness matter? Well, the reason is because if a distribution is positively skewed, then standard deviation actually overestimates risk. Now, why? Let me give you some intuition here. So let's say you're looking at this guy here, and you know it is right skewed. Now, what is standard deviation? Standard deviation actually measures average deviation. And this average deviation measures both positive deviation and negative deviation, right? So essentially, you can see that when you're calculating standard deviation, it will actually calculate positive deviations. But if you're an investor, you will not care about positive, sorry, I should not say not care about. But if you're an investor, positive deviation does not consider it as a risk. It is a reward, right? So what is a positive deviation? Let's say that this is the mean here. This is positive deviation, right? A larger positive deviation basically means you're having a higher return. So you should be happy for it. So it is not a risk. However, you can see that when you're calculating standard deviation, when the distribution is right skewed, the positive deviation part will actually inflate your calculation of standard deviation. In this sense, standard deviation overestimates risk. And then you can imagine that when the distribution is negatively skewed, right? In this case, standard deviation will actually underestimate risk. Why? Well, the reason is quite similar to the case when you're having a right skewed distribution, right? When the distribution is left skewed, it means that the negative deviation, right? So this is the negative deviation, is much larger compared with positive deviation. However, when you're calculating standard deviation, you're not differentiate between negative deviation and positive deviation, and you're just calculating an average. So in the end, you can see that including this smaller positive deviation will actually underestimate your risk of your returns. Okay. Now, to measure fat tail, we talk about kurtosis. So kurtosis, you can see that the calculation here or the definition here is not complicated, right? So again, you're looking at the deviation from the mean, but now you're using a exponential of 4. And additionally, you will use this minus 3, right? Now, if you have a normal distribution, kurtosis is always 0. And if kurtosis is larger than 0, then this implies your distribution has a fat tail. And what does fat tail exactly mean? Well, it basically means the more extreme values have higher likelihood compared with a normal distribution. And let's see how this works. So you can see that now we have two distribution here, right? The gray line, so it gives you normal distribution. And then the blue line gives you the fat-tailed distribution. Now let me explain why this is called fat tail. What is tail? Wow, this is easy, right? So these are two tails on the two sides. And now, which one has a fatter tail? Well, this blue curve, right? Because you can see that the thickness of this tail here is given by this distance. And for normal distribution, its thickness is given by this much shorter interval. So you can see that essentially this blue line has fatter tail, and you can see that it has actually slender shoulder, right? The reason is because the mass here, the mass from the probability distribution gets shifted to the tail. So that's why this blue lined probability density has a fat tail. And you can see that the result of fat tail is extreme values become more likely, right? Because you can see that the extreme values for normal distribution is just given by this number, right? To be more specific, let's say the rate of, let's look at this rate of return of minus 0.4, which is minus 40%. So you can see that the likelihood of this negative 40% loss is actually given by this very small number on this normal distribution. But then it is given by a much larger, or the probability, the likelihood has a much larger value on this blue curve, right? So you can see that fat tail essentially means extreme events become more likely. And then you can imagine that when you're having a fat tail, the assumption of normal distribution will underestimate the likelihood of large losses and large gains. Right? Okay, so this basically means that if returns they are asymmetric, and if returns they have fat tails, we should think about some better or alternative risk measures other than standard deviation, right? So now let's see what kind of risk measures we have here. If you have taken a risk management course, then you should have seen these measures. But if you have not, possibly this is the first time you learn about these measures, and I would say they are quite important, no matter in invest management or risk management. So the first one is VAR, which is value at risk. So what is the value at risk? Well, it is your loss corresponding to a very low percentile of your return distribution. So let me give you an example. This will be easy to understand. So let's say this is your this is the distribution of your return. And now let's say we have a value of let's say it's minus 0.5 or minus 50%. So let's say this corresponds to a probability distribution of 1%, right? So in this case, you can see that the value at risk, which corresponds to this 1% case, is minus 50%. We could also look at the normal distribution. So you can see here it says the value at risk at the fifth percentile return is given by mean minus 2.33 standard deviation, and the value at risk at fifth percent return is given by mean minus 1.65 times standard deviation. So what does this mean here? Well, it means if you have a standard deviation, if you have a normal distribution, then let's say this is the mean. And let's say this is the VAR at 1%. Then it basically means the probability here equals 1%. That is, probability of x smaller than VAR 1% equals 1%. And you can see that this value is given by mean minus 2.33 ST. That is, you will have one SD and another SD and 0.33 SD. Okay, the second related definition is called expected shortfall. So it is the expected loss in the worst case scenario. It is also called conditional tail expectation, and it is the more conservative measure of downside risk compared with VAR. So what is the expected shortfall? Well, let me continue use this picture. Okay, let's say this 1% value and risk is minus 50%. I'm just writing down a random number here. I'm pretty sure it's not minus 50%. So what is the expected shortfall? Well, it's expected shortfall here equals the expected value of the returns conditional on return is smaller than minus 50%. Of course, this basically requires a understanding of conditional expectation. So if you have difficulty in understanding this formula, which is fine, because I will not ask you to calculate expected shortfall. Okay, the third alternative risk measure is called lower partial standard deviation. Well, this one is easy to understand. It basically means you're not calculating the full standard deviation. You will use a partial one. What does partial here means? Well, it means that you will only look at negative deviations from the risk-free rate, right? So you can look at this, the formula here. This is essentially a formula to calculate sample standard deviation, but it has some additional condition. So you will only look at returns which is below the risk-free rate, right? So you can see why this is called lower partial standard deviation. Essentially, you can think that you can separate returns into two categories. The first category contains returns which are larger than the risk-free rate, and you will ignore these returns to calculate your standard deviation, because if return is larger than risk-free rate, which means you're earning a positive excess return, so you don't care about these positive deviations. What truly makes you worry, right, is these losses. So you will just want to calculate the returns which below risk-free rate. And you can see that if a return is below risk-free rate, then the excess return is negative. And then based on the definition of lower partial standard deviation, we can define a alternative Sharpe ratio. Remember what is Sharpe ratio, right? So Sharpe ratio is the average return minus the risk-free rate divided by the standard deviation of the return. But you can see that here we're using the full full standard deviation, right? And now we have defined lower partial standard deviation. So if we change this complete standard deviation measure into this partial standard deviation, right? So if we use lower partial standard deviation, so it should be LPST. Now we will have Sortino ratio. Okay, we could also use another alternative risk measure, which is called relative frequency of large and negative return. So the motivation here is sometimes, even if you look at daily returns, you can see that stock returns, sometimes they will jump. That is, you will see a large, big, sudden movement. Right? If you remember the market response during COVID, back in March, there was several days the SP 500 had a daily returns about -8 or -9. And these are very large jumps. And possibly you can see jumps like this every 20 years. But still, these jumps actually happen. So you can see that from an investor's perspective, these huge negative jumps are definitely a huge risk, right? You don't want to wake up and find out the market has dropped 10% just for one day, right? So how do you measure this kind of risk? Well, you will use this. You will first calculate the percentage of the returns with, let's say, with negative 3 sigma standard deviation. Okay, that's bad language. So you will first calculate the percentage of returns which are 3 standard deviation below the mean. And then you will calculate the percentage of returns which are 3 standard deviations below the mean, assuming you have a normal distribution, right? And then you will compare these two fractions. So let's say, let me try to give you a example here. So let's say you have a bunch of data, right? So a bunch of realized returns, right? And now let's say these are your returns. These are your data points. So you find out your mean is actually, let's say, 8%. And you find out your standard deviation is, let's say, 20%. So what is this? So what is the return which is 3 standard deviation below the mean? Well, the return should be 8 minus 20 times 3, which is minus 42%, right? So let's say you're looking at your realized returns. You have a total of 100 returns. And you find out, let's say this one is minus 40. And this one is minus 53. This one is minus 60. So now you can find out the fraction of observations with returns 3 standard deviation below the mean is given by these two guys divided by the total number of returns, right? So you can find out, let's call this below, so let's call this below 3 sigma return. Of course, you can see that this sigma here refers to standard deviation. So below 3 sigma return percentage, right? So it is given by 2 divided by 100, which is 2%. And next, you want to think about what is the fraction of this kind of below 3 sigma return if your return satisfies a normal distribution. So what you will do is you will look at a normal distribution of 50. Now you will look at a normal distribution which has a mean of 8% and a standard deviation of 20%. And then you know that this is a normal distribution. So giving you the mean and the standard deviation, you can find out any probability, right? So you can find out under this probability distribution, the probability of a return which is smaller than minus 52%, let's say it's given by 1.3%, right? And then in this case, you can get a measure of how risky your returns are, right? So you can basically see that if in this benchmark case, if returns satisfy a normal distribution with a mean of 8% and a SD of 20%, then there is only 1.3% chance you will get a negative 3 sigma return. But then you can see that in your real returns, you have a 2% chance. Right? So basically, you can see that this is riskier. So basically, you can see that your returns are riskier compared with returns implied by a normal distribution. And obviously, you can use this measure across multiple different portfolios, right? Let's say if portfolio A gives you a return, gives you a percentage of 2%, then if portfolio B gives you a percentage of 5%, then you would know that, well, this portfolio B has much larger chance to get hit by large negative returns. So potentially it's much more riskier. Right? Now, let's look at some interesting data. Because we have learned these alternative risk measures, so now we could use these definitions, use these formulas to actually calculate different return series. So after calculation, we will be able to find out these different investments performance and their risks. Right? So basically, we will look at first we will look at T-bills and T-bonds and U.S. equity index. So here we are having some frequency distributions. What you can see here is, so if you look at this T-bills, you can see that 90% of the time, right? If you look at this number, 70% of the time, T-bills have a return between 0 to 5. And of course, you can find out other numbers, right? But you can see that the distribution of the T-bill returns has a small variance, right? Its volatility is relatively small compared with the T-bonds and the equity market index. And then if you look at T-bonds, you can see that its variance is larger, right? And if you examine the equity market index, it's much larger compared with T-bonds. Right? So basically, this gives you the common sense everybody knows. That is, the equity market is riskier compared with long-term government bond, and long-term government bond is riskier compared with short-term government T-bills. And you can actually see this from this table, which gives you some basic summary about the risk and returns of T-bills, T-bonds, and equity. What you can see here is the standard deviation of T-bill is quite small. It's almost about 3. And T-bond is 10. And then you can see that for equity, it's about 20. Of course, you also have higher returns in equity compared with T-bonds. Now, we could also look at the equity market index's volatility in a more detailed way. What you are seeing here is we're looking at the annualized volatility of the monthly excess returns on the market index. So again, this is about the US market. What you can see here is this time, the equity market was extremely volatile, right? You can see that the annualized volatility is about 70. So because this is the I forget the name. What's the name for this period? The Great Depression. But you can see that after the Great Depression, the volatility pattern of the equity market is actually quite stable, right? So this is nice. This basically means that if you use the estimation of the volatility during this period to predict the volatility in the future, this period, then you can see that your estimation will be roughly correct. Okay. Next, in this picture, we compare annualized volatility between the actual returns and a normal distribution. So here, these blue bars, right? These blue bars, we're looking at the distribution of annualized volatility for monthly excess returns. So these are distribution for actual returns. And then for these black bars, we're looking at the frequency for returns implied by a normal distribution. So this is really a theoretical result. What you can see here is the actual returns, that is the frequency, these blue bars. What you can see here is blue bars, they have fat tail. How do you see this? Well, this might be hard to see. But what you can see here is you have blue bars here in these extreme returns. However, you don't have black bars, right? So if you have blue bars here, but you don't have black bars, this essentially means you're having some positive probability to get extreme negative returns. And then if you look at these positive returns, what you can see here is, again, you have these blue bars, but these black bars have disappeared, which means you have some high positive probabilities to get extreme positive returns. However, if you're under the assumption of normal distribution, then the probability is actually almost zero, right? So essentially, if you want to draw a smooth curve, it basically means the actual returns looks like this. And the normal distribution looks like this. Right? That is, during these extreme regions, the probability of extreme negative values and extreme positive values are actually higher on this blue curve compared with this black curve. And the black curve is the curve implied by normal distribution. So this is a sign of fat tail. Okay, we could also look at some measures, some numerical measures of these 4 different kinds of portfolios. So the first portfolio is the market index. And then these are so-called style portfolios. So what is big growth? Well, it's big firm and growth firms. Big value means big firms and value firms. Small growth, small firm and growth firms. Small value means small firms and value firms. And we learned about the difference between value and growth in the equity chapter, right? One measure of value versus growth is the BM ratio, right? So we could use book value versus market value to measure a firm's or to measure whether a firm is a value firm or a growth firm. Oh, clearly market value is really the number of shares times stock price. Book value is just shareholders' equity. You can get this number from a firm's balance sheet. And we also defined in the equity chapter that if a firm has high book to market ratio, then it is basically a value firm. If a firm has low book to market ratio, then it is considered as a growth firm. So what you can see here is, I guess we have so many numbers here. So let's just focus on this market index. Okay. So what you can see here is, well, you have excess return, easy to understand. Standard deviation, easy to understand. Sharpe ratio, 0.45. Well, you can basically see that for the last 90 years, right, the Sharpe ratio of the market has been around, even for different portfolios, has been around 0.5. And then we have lower partial standard deviation. What you can see here is lower partial standard deviation is actually quite close to the conventional definition of standard deviation, right? So these numbers are very similar. This basically means that there is not a lot of asymmetry in the returns. And you can see that if you look at this number of skew here, it's 0.2. It's very small. It basically means that the actual market returns are roughly symmetric. And if you look at kurtosis, you can see that this is the major deviation from normal distribution. You can see that, and you can actually see this from other portfolios, right? So you can see that the equity market has a very fat tail. And if you look at this small value, if you look at value, right? If you look at big value and small value, these portfolios, they have much larger fat tails, even compared with the market index. Right? So this basically means that if you're a value investor, right, it's very likely you will be hit by big negative returns and large positive returns. And then we have VAR here. So the value at risk measure is at the 1%, it's at this 1% cutoff. And next we can see that the VAR at 1% cutoff by assuming normal distribution, it is slightly larger, right? And you can see that for all other cases, it is only slightly larger, right? So this basically tells you that, well, maybe normal distribution is not such a assumption for security returns. And if you compare the expected shortfall and the VAR, you can see that expected shortfall is always smaller. And then the table also gives you some statistics for returns between 1952 to 2016. What can we see here? Well, what you can see here is investing in stock market actually became less risky after 1950s, right? If you look at the standard deviation here, and then if you look at the standard deviation here, so you can see that there is a decrease in standard deviation, right? Which means that standard deviation before 1950 was actually quite large. And what about Sharpe ratio? Well, you can see that Sharpe ratio roughly stays the same, right? And what about skew? Skew actually becomes negative. However, you can see that it's still a very small number, which means that again, actual returns, they are roughly symmetric. Oh, we also have this nice thing, that is kurtosis becomes smaller. This basically means the tail of the actual distribution becomes less fat after 1950s, right? So this is nice. It means that as an investor, you're less likely to get price jumps. And if you look at this VAR here, value at risk, it's actually larger, right? Again, this is nice. This also means that investment became less risky after 1950s. Okay, last picture. So this is a picture about cross-country comparison. So we basically look at returns for 115 years across these more than, I guess, about 20 countries, right? So you can see that Canada has a risk premium, which is the market return minus risk-free rate. So Canada has a, this is pretty low, so it's less than 6% risk premium. And then for US, it has close to 8% risk premium. Can you say the US market has better performance compared with the Canadian market? Well, you cannot say this because now you only have the data on returns. You don't have the data on risk. When you're measuring returns, you have to always consider both returns and risk. So without knowing which one is riskier, we really don't know whether US market has a better performance than the Canada market. Okay. Now let's talk about performance evaluation. So what is performance evaluation? Well, think about a realistic scenario, right? So let's say you work at a pension fund, right? And let's say you manage $10 billion and you have to invest these $10 billion of money into different managers, different fund managers. So basically you have to evaluate these fund managers' performances, right? So this is the first motivational example. The second motivational example is, let's say you're just a retail investor and you're considering investing in some mutual funds. And you can see that normally, I guess in Canada, I guess you have at least several thousand different mutual funds. Now you need to understand, how do I choose several mutual funds which fit my needs? So to understand this, you have to understand how to evaluate these mutual funds, right? So now here I am giving you some, so this is an example from Fidelity. It's a US broker. And you can see that when you want to choose some mutual funds to purchase from Fidelity, it will show you these performance metrics, right? So it will tell you what is the Morningstar category risk, what is the standard deviation, what is the 3-year Sharpe ratio, what's the beta, what's R squared. So clearly, as a retail investor, you have to understand these different metrics to make informed decisions, right? So you can see that understanding performance evaluation is actually pretty important, even if you're just a retail investor. And then you could also see that so Fidelity will also show you some sort of rank. So you can see that let's say I'm trying to evaluate this Fidelity Blue Chip Growth Fund, and I find out among 1,300 funds, it has a 8% rank, right? It basically means it outperforms 92% of other funds, right? So again, you need to understand these basic performance metrics, right? Okay. Now, let's think about how do we do performance evaluation. But before that, let's first think about to reviewing how to calculate returns. To be more specific, we want to think about how to calculate multi-period returns. Obviously, we talk about a lot of different ways to calculate returns, right? Such as holding period return, annualized return, and we also talk about this EAR and APR. So here we're thinking about the following scenario. That is, you have made some investment, and this investment has an investment horizon of multiple periods. So now you want to understand your investment's return. And then to calculate this multi-period return, we have two kinds of methods. The first is time-weighted. The second is dollar-weighted. And time-weighted return is actually a familiar one. It's really the same as the geometric average return. That is, it is really the same as the annualized return, right? So you can see that, let's say you have invested for n periods, right? That is period 1, period 2, period n. And then for the first period, you have a realized return of R1. For the second period, you have a realized return of R2. And you would do some calculation, and after calculating n returns, you will find all these returns, right? Now you want to understand what is your annualized return, right? So one way to do this, you would basically just use this geometric average. Right? So here the capital G refers to geometric average. And you can see that, well, nothing fancy here, just plain boring calculation of annualized return. So I will just continue to the next dollar-weighted return. Now, so it's just really a fancy, it also has a name of money-weighted. Some people also call it as money-weighted return. So dollar-weighted return is just a fancy name for internal rate of return. If you have taken corporate finance 1, then you should be very familiar with this internal rate of return, right? So it is really used in this discounted cash flow valuation. Now, what is the definition of IRR? Well, IRR is the return or the rate of return which equates the present value of all cash flows with the initial investment, right? So basically, in terms of formula, you can see that if you have these cash flows in n different periods, and your initial investment was given by PV, then the dollar valued return would be given by R. Obviously, this is the exact definition of internal rate of return. So if you have any difficulty in understanding internal rate of return, the best textbook or the material you can use is your Corporate Finance 1 lecture note. And you can see that the returns are weighted by dollars in each period if you consider these guys, C1, C2 to Cn, as weights. Right? So essentially you can see that because if you're calculating internal rate of return, this return is dollar weighted. It means that if this, let's say if the end period cash flow is larger, then you can imagine that the nth period return will have a larger effect on your calculation of the internal rate of return. Okay, now let's see this very simple example here. So let's say you're making some investment, and let's say we have this timeline here. So let's say at time 0, at the beginning of the time, you invested $50. And now, at time 1, that is after one period, so you will continue invest to buy a second share, right? So that is at the end of the first year, you would purchase another share. And these are your investments or your cash outflow. And then at date 1, date 1 is a bad terminology. So at the end of the first year, right, you will get $2 dividend. Of course, this is your cash inflow. And then at this end of the second year, you decide to sell both shares. So now you will get a $2 dividend again, plus selling of 2 shares at $54. So you will have, let's see, what's the number here? 110, right? Now, what is the dollar weighted return? Well, again, dollar weighted return is really just the internal rate of return. Internal rate of return will try to equate the cash inflow to the cash outflow, both in present value terms, right? So what is the present value of your cash outflow? So it's 50 plus 53 times 1 plus r, right? What is your cash inflow? Well, you have the cash inflow at the end of the first year. So it's 2 divided by 1 plus r. And then at the end of the second year, it would be 110 divided by 1 plus r squared. And this will solve r equals 7.11%. Now, what is the time-weighted return? Well, it's time-weighted, which means you will separately calculate the returns in period 1 and period 2, and then you will calculate its geometric average, right? So let's say the period 1 return is given by, I guess it's given by what? R1. This is given by R2. So what is R1 here? Well, in the beginning, right, you have 50. And at the end of the period, this 50 will increase to 53. And then you will get $2 of dividend. So this gives you, let me see, 10%. Oh, it's actually a very easy calculation, 10%. Now R2, well, for R2, you actually have 2 shares, right? And the cost of the shares is 53 times 2. And then at the end of the day, you will get 110, yes. Yeah, you will have 110 and minus 53 times 2. So this gives you, this gives you 5.66%. and then it's it's time weighted. So you will calculate the geometric average, which is 1 plus R1, 1 plus R2, and then we have 2 years, so it's 1 over 2 minus 1. So this gives us a number of 7.81. Now, think about this. If you compare these two returns, you can see that you're having different numbers, right? If it's a dollar weighted return, you have a lower return. If it's time weighted, then you have higher return here. Now, why do you get this result? Well, because in this case, when you're calculating the dollar weighted return, the weight is given by dollars. And you can see that this is the second period. And you can see that second period has a larger weight because you have a number of 112 here, right? Oh, why do we have 112? Oh, sorry, I made some mistake here. Gosh, you know what? We should have a dividend of 4 because we have 2 shares. So here I have to use 4 here. No, gosh. So this would be 112, and this should still be 2, but then we have to consider this 2 shares. So it's 112. What else? Do I have to? Yeah, this part. So this part should be 112. Okay. Okay, let's go back our discussion. So why dollar weighted average has a smaller value? So the reason is because when you're calculating the dollar weighted return, this 112 is a larger number. Is a large number. This implies that the second period return has a larger weight. And you can see that second period return is actually lower compared with the first period return. So when you're calculating the dollar weighted return, if you put a larger weight on lower return, then in the end, your final calculated return will be lower compared with this time weighted return. To some sense, you can see that when you're calculating time weighted return, these returns, they have equal weight, right? So that naturally means that the lower return in the second period will have a smaller effect when you're calculating time weighted return. So time weighted return will be larger compared with the dollar weighted return. Okay, clearly calculating return is really the first step to do this performance evaluation. As I mentioned, when you're evaluating performance is multiple dimensional. It's not just about returns. You have to think about risk. I mean, sometimes people are naive, right? Say someone could potentially ask me, hey, what was your investment return? And if I tell this person, hey, last year my return was 30%, and then this guy might think, okay, 30% return, and the market return was only 10%. So there is extra 20%. That means my return is outperforming the market. But you have to see that this kind of logic is not correct. The reason is because even if the market only returns 10%, my portfolio returns 30%. It's possible that my portfolio is a leveraged portfolio. So I only got this 30% return through increased risk, right? So this basically means that when you're evaluating performance, you have to think about the trade-off between risk and returns, right? So the first way, or more simpler way to think about performance is we have to first obviously adjust returns for risk, right? And the most simplest way is to find out a comparison universe. And then I will use this comparison universe as the basis. And then I could see what is my portfolio's percentage or my portfolio's performance relative to this comparison universe. Okay, let me give you a example. So let's say, let me go to this fidelity picture here. So let's say I am thinking about buying or investing in US tech firms. So I am thinking about this so-called select technology portfolio, right? And I know that, well, last year it had some good return. But does this mean I should invest in this technology portfolio? Well, I have to adjust for risk, right? So one simple way to adjust for risk is I compare this fidelity technology portfolio with other technology portfolio, right? For example, I could choose 10 mutual funds. And then they are called fidelity technology portfolio. And then I have other candidates. Let's say this is Goldman Sachs technology portfolio, Morgan Stanley technology portfolio, and Vanguard technology portfolio, BlackRock technology portfolio, right? Of course, you can add all kinds of investment firms here, right? So let's say you find out these 10 different portfolios and you find out, well, this fidelity technology portfolio has higher return than the other 9 portfolios. So this could tell you that, well, it is the best among 10 similar portfolios. So this could potentially be a really good investment, right? So that's the idea of comparison universe. Okay, so let's see this example here. So let's say we have a mutual fund. It's called the Markowell Group. I don't know why a mutual fund would have a name as this. It's pretty weird. Now let's say you want to invest in this mutual fund. And then what you will do is you will compare this mutual fund to other similar mutual funds, right? So what you will see is you will look at its returns across different time, right? So the first one quarter, basically means the last quarter's return. 1 year means the last 12-month return. 3 years means the last 36-month return. 5 years, last 60-month return. And then these lines actually represent percentile. So this is bottom 5% percentile. This is the top 95 percentile. So this is, I think it's 75 percentile. And this one should be 25 percentile. And this is the median, 50 percentile. Right? And what you can see here is for the last 1 quarter, this Markowell fund was about outperforming 75% of other similar funds, right? So the fund was actually doing fine for the last quarter. And you can see that the blue rectangle represents the performance of SP 500, the market index, right? So it was outperforming the market index. But then if you look for longer time, right, for the last 12 months, you can see that it's just slightly above 25%. So it basically means if you look at the last 12-month returns, this market we found was just outperforming about 30% of other similar funds. And then if you look at other longer years, right? So this is about potentially about 40%. So this is again, I guess, about 45%. So you would see that this fund did not have very good performance over a longer term, right? Potentially you won't want to buy this. Okay, now let's talk about some more formal performance measures. So we have discussed actually Sharpe ratio, and then we will discuss M2 measure. This measure is actually quite peculiar. I don't think it's widely used, but well, it's still good to know there is a M2 measure. And then Jensen's alpha, which is obviously pretty important. And then we have trainer ratio and information ratio. This one is often used by hedge fund. And Jensen's alpha is actually pretty important. It is used by both practitioners and professors. Okay, well, Sharpe ratio. We have learned about this in corporate finance, and I think I may have defined Sharpe ratio in this class in previous lectures. Sharpe ratio is calculated as the average return of portfolio P minus the average risk-free rate divided by the standard deviation of the portfolio's return. Here P refers to the portfolio, right? You wanted to evaluate. And you can see that Sharpe ratio is a reward to risk ratio, right? And you can see that this is your reward, the excess return, the additional return you get above the risk-free rate. And then this is the risk, right? To get this additional reward, you have to bear the risk, which is measured by standard deviation. And then you can see here, we actually measure risk by using standard deviation, right? The reason is because now our purpose is we are just investing this entire, we are just evaluating this entire portfolio, right? So the idea is like this. Let's say you have $10,000 and you have used up this $10,000 to build a portfolio, right? So this is your full portfolio. And now you want to investigate, you want to evaluate this full portfolio's performance. In this case, using Sharpe ratio is a good choice. Now, when you're thinking about Sharpe ratio, what's the comparison? Well, a basic comparison is you can compare your portfolio's Sharpe ratio with Sharpe ratio of the market index. For example, let's say you're a investor, right? You have built a portfolio. Let's say for 2019 to 2020, let's say you have bought Apple, right? Maybe Lululemon, maybe Shopify, right? And okay, let's add more. Amazon, right? Google, maybe Boeing, maybe Disney, right? Maybe Starbucks. Right? Okay, so this is your portfolio. And then at the end of the 2020, you calculated this portfolio has a Sharpe ratio of 0.7. Now, is this 0.7 good or bad? Well, what you can do is, now you look at SP 500, right? So this is the US large market index. Again, the same year. You find out its Sharpe ratio is 0.43. Now you can say, okay, my portfolio outperformed SP 500 by, I guess, by about 50% using Sharpe ratio, right? Okay, I have 4 minutes. Yeah, let me try to finish this M2 measure. So, first, why this is called M2 measure? Well, because it's a measure popularized by two Modigliani's, right? So we have two M's. So this Franco Modigliani is the M in the MM theorem. So this M2 measure for a portfolio P is constructed like this. So let's say I have a portfolio P and I want to understand its performance. So I want to compare this guy with the market index, right? But you can see that the market index and my performance could have different standard deviation. Now, what I'm trying to do here is I will want to scale my portfolio. I will force my portfolio to have the same standard deviation as the market index. And then I will use the return of this scaled portfolio. And I will use this scaled portfolio's return as a benchmark, right? And I will compare this scaled portfolio's return with the market return. Okay, let's see how exactly this works. So, portfolio P, right? And I wanted to make sure I can have a portfolio which has the same volatility as the market index. So what I'm gonna do is, if this is my portfolio P, I will mix this portfolio P with this risk-free asset. And you guys have learned in corporate finance too. If you mix a risky portfolio with a risk-free asset, then the mixture portfolio will have a lower volatility. For example, if this portfolio P has a 20% volatility, and then if I mix $10 of portfolio P with $10 of T-bills, then this mixture portfolio will only have a volatility of 10%, right? So here I will mix this portfolio P with T-bills, and I will build a adjusted portfolio P star. How do I determine the right mixture? Well, I will make sure P star have the same volatility as the market index. And next, I will compare the adjusted portfolio's return with the market index's return. So you can see that if this number is larger than 0, then I can say that my portfolio is outperforming the market. So the essence of this M2 measure is you're trying to adjust risk by forcing your portfolio to have the same volatility as the market index. Now, how do you force this? Well, you just mix your portfolio with some T-bills. I guess I'm running out of time, so I'll continue to talk about this M2 measure in the next lecture.